For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade. I'm just here to ask the questions. You know that, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Of course, Randy is off this week. Little time off there, maybe a semi-retirement type thing, test driving retirement a little bit. I don't think Randy's ever going to completely retire, but don't worry because we've got Jake Floyd with us here of Floyd Financial Group. Hey, Jake, how you doing this morning?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome, my friend. I hope everybody else is having a great Saturday here in the last bastion of sanity, Springfield, Missouri. Once again, we've got another great show lined up for us today. We're going to start off the show today by talking about current events. And really, there isn't a lot to talk about, but I want to bring up a couple of things that I read, and one of which is that the economy seems to be slowing a little bit faster than the Fed expected. What's your take on that one, Jake?
Yeah, so one of the things, again, if you've been listening to this show for a while, or even if you haven't, we've talked a lot about in order for there to be a recession or a downturn in the economy, the number one thing you need there is a rise in the unemployment rate. And, we really haven't seen that much over the last, even 4 years, really, since COVID. But we're starting to see it tick up just a little bit. And last week we saw the unemployment rate touch 4% for the first time in a while. People are like, 4%. 4% is not a high reading, frankly. No, it's not. But unemployment was as low as 3.4 not too long ago, and it's been ticking up a little bit at a time. And so as the unemployment rate goes up, it makes it more difficult for wages to increase. And as wages stop increasing, inflation comes down. And so this is the whole design of the Fed. As far as what their expectations are, I can't necessarily speak to that, but I would say that this is exactly what they're wanting to see. And it seems to me that it's a little bit of a Goldilocks scenario, meaning inflation is going to be coming down gradually, not too abruptly, and unemployment's not going to spike and skyrocket. And then the Fed will likely start to cut interest rates. This may be the safe landing that myself, along with others, were very critical about whether or not they could achieve it, but it probably looks more likely today that they could than any time in the last 4 years, in my opinion.
Yeah, well, this is almost halfway through the year, Jake, and in the beginning of the year, the end of last year, we had quite a different expectation. Why have things changed so much? I mean, last year, we thought we were going to see 4 rate decreases, and now they're talking about, we'll keep them the same. We probably, maybe even will have a rate hike. What has changed or transpired between then and now that has caused us to be in the situation that we're in right now?
I think there's just a lot of noise out there. I think people don't really understand what's going on, and they don't really know what to think. The Fed seems very ethereal, I think, to a lot of people, where it's just kind of nebulous and they just kind of do whatever they want to do. And if they wake up on the right side of the bed, they cut. If they wake up on the wrong side of the bed, they hike rates. And I would suggest that there's quite a lot more to it than that. And as critical as people have been of the Fed, it's hard to argue with the smoothness at which they raised rates and then cut them. I mean, people would say, well, in 2022, the market was down 20% based on them hiking rates. And you're right, it was. But, man, it could have been so much worse when you hike 525 basis points over the course of like 10 months. And, since then, we've recovered. Even at restrictive levels, we're near all-time highs. And we'll talk in the next segment a little bit about some of these people that are just sure that the world is going to end. And so I won't spoil that, but there's a lot of people out there that are just sure that this market is going to come down. And the counterintuitive nature of the market is if a lot of people think it's going to come down, guess what it's not going to do? Right. It's not going to come down. It's going to continue to run in a way that seems to defy gravity. And so when it comes to markets, it usually pays to lean the direction that everyone else is not leaning. And I would argue that there's probably more negativity out there than there is positivity.
Well, for me personally, and I mentioned this off the air, is that I have basically a positive consumer sentiment. Maybe that's just me individually in the way that I handle things, but what are you hearing from your clients when they call you and they say, Jake, what's going on out there in the world and the economy, and should I be worried about this? What are their concerns?
So most of my clients fit into one of two buckets. I have a lot of clients that are very concerned about us economically, immigration-wise, what that's doing to our economy, and therefore they're concerned about markets and their money and their retirement and those types of things, which I think is you're paying attention if you're worried about those things, right? Because there's a lot to be worried about. Then I have people that are kind of caught up a little bit in the euphoria of things, and they're like, hey, I heard NVIDIA split, and we need to talk about that. Basically, why are we not taking even more risk right here, trying to ride the markets higher? And basically, they don't see anything to be concerned about. I think we need to probably be somewhere in the middle of those two, especially as we approach the conventions in August, and then the general election in November, and then the aftermath. The market is up a lot over the last year, and pigs get fed and hogs get slaughtered. While I do think there can be some more upside in this market, I'm not looking for like a giant crash or anything. I do think that in the short term, 1, 2, 3 months, there's probably a bigger risk to the downside than to the upside.
We're talking with Jake Floyd of Floyd Financial Group. We're talking about current events, and as Jake mentioned later on in the program, we'll talk about doomsday predictions, those people who are predicting that the sky will fall, why they're saying such things. Also, stock splits later on in the program. We'll talk about some ways to make retirement a little less scary. Let's talk about the election a little bit here, Jake, in this country and also in France. Right now in this country, not much new out there. What's going on that we should know about, or is there anything? Are we just in a place where it's kind of wait and see?
As far as the election goes, Jeff, I think, like you said, it's definitely wait and see. There's really no new news. Everybody's repeating themselves over and over. It's, every day is a talk about how Biden can barely stand up and, how many people were at the Trump rally. And while I think those things are, necessary to say because not everybody's informed, I do think it's getting repetitive because there's not a whole lot to talk about. Trump is seeming to be waiting to pick his VP to see who he's running against because he's not convinced it's Joe Biden. There's a lot of people, including myself, that are not convinced it'll be Joe Biden. So he's trying to wait, and basically they can't wait any longer than the convention in August. Maybe they wait that long, maybe they don't wait quite that long, but it does seem that it's just wait and see in America for now on the election.
Okay, so let's talk about the French election. I understand that it happened, something like June 9th, something like that. What's at stake in France, and why are we talking about this?
Well, I think that election is a good precursor, a preview for our own election, because you have a fairly, right-leaning person that's very populist running against the establishment, incredibly liberal incumbent. And so he pretty much got his butt whipped, from what I could see, and then kind of cleaned out his parliament afterwards to kind of make way for the new president over there. So I think as it relates to here, I think that it shows populism is not just an American thing or just a French thing, right? It's something that is, people are just sick of the crap. And maybe I'm just speaking for myself. You guys can let me know if I am, but I think people are done with it. And if that can win in a place like France, how much more so is it likely to win here?
Yeah, I think that the French election can be a precursor or can give us some indication as to what's going to happen here. So certainly that is worth talking about. I want to talk about something else here, too. Apple Intelligence. I understand that Apple is coming up with their own version of AI. Is that right?
Yeah, everybody's been kind of waiting to see what Apple was going to do because they're obviously the 800-pound gorilla in the room with 2 billion iPhones being used on a daily basis. They've kind of unveiled what they're going to do. They're going to integrate ChatGPT as everybody else is, which is interesting that they're not coming up with their own type of thing. Again, I say it's interesting. It's not that surprising. I mean, they haven't innovated since Steve Jobs died, so I don't know why anybody's expecting them to innovate now. But it appears that they're just going to plug and play ChatGPT into iOS 18, which is their new operating system. I think what's maybe even more interesting than that is a lot of the backlash they've gotten, especially from Elon Musk, who basically said that if they implement Apple Intelligence the way they say they're going to with ChatGPT directly into the iOS, that he will ban all iPhones and all Apple products that run it from all the premises of his jobs and various things that he's doing because it's not secure. I think he has concerns, too, that ChatGPT will pick up on things that they're talking about and then, allow it to be used by the rest of the world, right? Because everybody's phone now, if you have Facebook or TikTok or a handful of other apps, your phone listens to you.
Yes, it does.
So if you're talking about, like we were talking about before we went on air here, Jeff, we were talking about Ford F-150s, right?
Yeah.
If you have a conversation with your friend about Ford F-150s and you have TikTok or Facebook on your phone, it's likely the next time you pick up your phone, you go to eBay or you go to some shopping app that Ford F-150s or Ford F-150 components will start showing up in there. So I think that's partially what Elon's concerned about is that, everybody's phone's listening to them. Yeah. Now we put ChatGPT on it with no regulation as far as what it can use and what it can't. So if he's sitting in a room talking about the next Tesla model with a bunch of iPhones, that information will likely get out. I think that's one of probably 100 concerns that he has. But yeah, I could see how that could be a problem.
We're talking with Jake Floyd of Floyd Financial Group. We've talked about current events here. And based on our conversation today, Jake, I'm pretty sure that some people may have some questions of you. Maybe they want to sit down with you and have an individual conversation with you about the market and the economy and how it may affect their journey towards a prosperous retirement. If that is you, we're offering a no-cost, no-obligation chance for you to sit down with Randy and or Jake at Floyd Financial Group and ask those questions. Call this number today, 417-889-7233. I know it's the weekend, but we've opened the phone lines for you, 417-889-7233. When you call that number, simply leave your name, your telephone number. That's all you've got to do. It's a very simple, quick conversation. Ashley will give you a call back during the week. She'll set up an appointment for you to sit down with Randy and or Jake at Floyd Financial Group. Maybe both if you're lucky, and have that conversation. Again, it's not going to cost you a dime, and absolutely there is no obligation, and certainly there is no judgment. So take advantage of this opportunity this weekend to get your questions answered and to put you on a path towards a confident retirement. Once again, that telephone number, 417-889-7233. And as always, you can find out more about our firm online at floydfinancialgroup.com. Time for a break, Jake. When we come back, we'll be talking about doomsday predictions and more when Show Me the Money continues on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about Chicken Little, Harry Dent, and doomsday predictions.
I've got to laugh about the name Harry Dent, only because Randy would laugh about Harry Dent if he were here. I don't know what's so funny about the name Harry Dent, but as you said, watching Randy laugh about the name Harry Dent is as much fun as the name Harry Dent itself. But anyway, doomsday predictions. It seems that when I look at the internet, I see TV, there's no lack of people with doomsday predictions. The sky is going to fall. It's sort of sensationalism, and I liken it to people who slow down to look at a car wreck, or in California, they'll slow down to look at somebody changing a tire. I don't understand it. But let's talk about Harry Dent here. I understand that he most recently made a prediction that I read just a couple of days ago that said, we're in for an economic downturn that is worse than 2008.
Yeah, so I think the old adage, consider the source, is appropriate with all these people we're about to talk about. Harry Dent, as we mentioned last week or the week before, we were talking about the fact that he made some pretty incredible predictions back in the day. He actually used to be very bullish, meaning he thought the market was going to go up. And famously, I think it was in the 80s when the Dow was about 2,000 or 3,000, he said it was going to go to 30. And everybody kind of laughed at him, it was going to go 30,000. And he was a little bit off on his timing. He was about 5 years, it was about 5 years later than he predicted, but it did reach 30,000. And so even a blind hog finds an acorn every once in a while, as my dad would say.
Right.
Or, a broken clock is right twice a day. Since that time, though, he's pretty much been trying to predict downturns over and over and over. And he did say before 2008 that there was going to be a downturn, but, he'd been saying there was going to be, and hasn't stopped saying it since. And he's been wrong. And then famously, and I think it was 18 or so, he said, we're going to have a 60% downturn this year, and if we don't, I'm going to quit my job. And I was like, well, I guess he's still here. We didn't. It's a little bit like these people saying they're going to leave the country, if Trump gets reelected. We'll let that sleeping dog lie. However, Harry Dent, right, he predicted that we'd have an 86% crash in the S&P. This is like a few days ago. 86% down on the S&P, 92% down on the NASDAQ, and NVIDIA would go down 98% at some point.
Okay.
And he thinks this is maybe next year, is what he's saying. I mean, every company eventually has its day, but I would be willing to bet a lot of money that NVIDIA does not go down 98% next year.
Wouldn't think so.
Even in pretty awful odds, I would still bet a lot of money. This guy is obviously just trying to sell books, right? That's what he does. He writes books. He's like, here's the next big crash, yada, yada. Everybody buys it. And he doesn't have to be right in order to sell books.
No.
If he wrote a book that said, hey, the market's going to continue to go up 6% a year very steadily, and, everybody's going to be well off and good in retirement and nothing bad's ever going to happen again, that book wouldn't sell. And so he has to make it sound even more crazy than he has ever before in the past. Calling for a 92% correction on the NASDAQ is insanity. You would probably have the closing of the stock market permanently before it even got that low, right? Just from panic and everything else. So these numbers are just, he's totally pulling them out of thin air. He, like others, have an agenda. And so, like I said earlier, we need to consider the source, whether it's Harry Dent or Jeremy Grantham or Peter Schiff, any of these guys, even the super conservative news, right, that are trying to sell gold. And they're like, the world's going to fall apart and you need to buy gold. Meanwhile, they're making 10 to 30% commission on all the gold you buy right on the other side of that, right? So it's just, we need to be careful who we listen to because they're all trying to sell you something.
Yeah, and it says right here, the U.S. is poised to see an epic stock market crash next year. According to Harry Dent, the bust could send the U.S. into a depression, he warned. Now, we've been in a depression before. I don't know that we haven't learned something from the first time, Jake. Correct me if I'm wrong, but what are the chances that we will see a depression, no less a recession?
A depression, the likes of like the Great Depression, that type of thing, is going to take some global food collapse, all that type of stuff in order to take place. And while we are seeing some things on that horizon that are a little concerning, there's been a lot of people predicting that now for 4 years that we're going to have a food shortage and that, Americans aren't going to be able to buy food on the shelves and all that kind of thing. And so far, that hasn't happened. I'm not saying it's never going to happen, but I think predicting a depression with really nothing to point at other than, we're just due for a depression is basically what he's saying. And that monetary policy and the Fed have artificially kicked the can down the road. Monetary policy definitely has kept us from having a recession. You have to have some kind of major catalyst in order to have a 2008 scenario or a 1930s scenario. And at this point, I don't see that catalyst. That doesn't mean there's not going to be one that pops up tomorrow that we haven't foreseen. But I think he's just going to continue to keep on predicting depressions and recessions, and then eventually we'll have one.
Yeah, I mean, if you predict something long enough, eventually it's going to happen. May not be in our lifetime, but eventually it's going to happen. And again, follow the money. It gets down to the fact that he wants to sell books. And if you don't say anything outrageous, people are not going to buy your books or they're not going to pay any attention to you. We were talking about Marko Kolanovic off the air as well, too. He's maintaining his bearish stance, predicting a significant 20% decline in the S&P 500. Where do you think he gets his information, and why would he say something like that?
Yeah, so Kolanovic used to be referred to as what's called a perma bull, meaning so Harry Dent would be a perma bear. He's always negative, and a perma bull would be somebody that's always thinking the market's going to go higher no matter how high it goes. And Marko Kolanovic usually over the last decade or so has had one of the highest price targets on the S&P at all times, meaning he thinks it's going to go up more than anybody. But he's been negative on the market, but he's been negative since before November of last year, which if anybody's been in the market over the last 8 to 10 months, you know that the market is up a lot. And so he's maintaining that negative stance. And the reason why I wanted to bring that up is if somebody like Harry Dent is going to be correct, you can't have everybody expecting him to be correct, because if they're expecting him to be correct, they're already out of the stock market and there's no selling pressure, and the market will just continue to go up. And so what made 2008 unique is we had a unique period of euphoria there where pretty much nobody thought the market was going to come down. And that's what primed the pump for the housing crisis to really take out a big swath of the market. We have to have a sufficient amount of optimism in order to create one of those big downturns like that. And I honestly think if you look around any news outlet, which I don't really watch a lot of mainstream news these days just because it's all garbage, pretty much all the talking heads are very negative, in my opinion. There's a handful that are not, but for the most part, the overwhelming sentiment is, this market's overbought, it's gone too far too fast, and it's overvalued, stocks are too expensive, all that kind of thing. That's usually not the recipe to have a crash. That's the recipe for them to be wrong and the market to continue churning higher. Now, I do agree that there are quite a few risks out there, like the election and other things, but the market has a way of defying the odds in most circumstances.
We're talking with Jake Floyd of Floyd Financial Group. We're talking about turning down the noise, really deciphering what you read in the internet feeds and also what you see on TV, and putting it into some sort of perspective. Another fellow that comes up regularly is Jeff Gundlach, and I'm going to read here, quote, in his annual Just Markets webcast presented January the 9th, Double Line CEO Jeff Gundlach, among other outlooks, shares his forecast for a U.S. recession. He sees U.S. stocks forming a bearish double top, and down the road expects an initial rally in bonds upon recession, followed by an inflationary monetary response. So that's Gundlach. What do you take from that?
I take it that he has more college education than me with that mouthful of word soup that he put out in that outlet.
I'm telling you, all these big words got my head spinning here. But the bottom line is that, these people come up with these sensational things. And it's, again, I liken it to, you're in a traffic jam or something, and you wonder, well, what the heck is going on up there? And you go up, and it's a double lane thing, it's a split thing, and there's an accident on the other side of the freeway. People slow down to watch something like this. It gets their attention. And I think many times, because we're creatures of emotion, Jake, that sometimes emotions can really get in the way of deciphering critical thinking. What do you think about that?
Since he made that prediction, the market's up 15% in 5 months. So I think he was dead wrong. Bonds got clobbered after he said that. So he's a bond guy. His mainstay of his business is trading in the bond market. If the market goes down, that's good for his business. So again, it's another case of Harry Dent or Peter Schiff who wants to sell gold, Jeremy Grantham, similar story, where he wants it to go down. So when he's predicting it's going to go down, you really have to be careful with listening to that guy, because you having that bias clouds your judgment. Like I said, he's been dead wrong since then. I think that when it comes to predicting recessions, it's hard to predict a big recession because they are, by definition, usually coming from things that you can't predict. The black swan type events where the housing market's a little bit of an exception to that, because with the benefit of hindsight, we can go back and say, the practices that were in place on appraisals and signature loans and things like that obviously weren't good, coupled with leverage that banks allow, created a kind of a perfect storm there. But there are very many smart people that did not pick up on that. There's a handful of people that did, but I think that when it comes to recessions, if you sit around waiting for a recession to hit you, you're going to miss out on making a lot of money.
Jake, what would you say is the takeaway from this conversation about these people who predict that the sky is falling? There's so much noise out there. I'm sure that you get phone calls there at Floyd Financial Group from people saying, Jake, I heard this, or I saw that. How do you calm people down, or how do you make people see behind what the really motive is for people to say these things?
Well, I think that a lot of people really haven't thought about why they would say those things. And so that's what I usually talk with them about, is say, hey, let's expose, kind of why these people are saying what they're saying. It doesn't necessarily make them wrong, right? And I'm not saying we can't have a recession. That's not what I'm saying. What I am saying is, for every recession time frame where we're having a recession, there's 8 to 10 times as much time that we're not having a recession. If we allow every little thing to keep us out of investments, out of the market, we're simply going to miss out on a lot of gains. If there's something to worry about, we will worry about it. But for the most part, everything at this point is fear of something that might happen.
Might happen.
And so let's try to stay calm and composed and without emotion until something actually does happen. And then we can deal with it accordingly.
Yeah, and as I said, I think there's been a suspension of critical thinking in this country, and people take too much stock in what these talking heads say. We're talking with Jake Floyd of Floyd Financial Group. Our program, of course, is called Show Me the Money. Thank you for joining us here in this fine Saturday morning. We hope you're having a good weekend, and we want to remind you that if you would like to sit down with Jake, ask your individual questions, or Randy, whenever Randy is in the office, we're inviting you to give us a call this weekend. Our telephone number, 417-889-7233. 417-889-7233. We're right here local in Springfield, Missouri. Not one of those national shows. You can sit down and talk to the person that you're actually hearing on the radio. Give that number a call this weekend. Leave your name, telephone number. Ashley will call you back during the week and set up a convenient time for you to talk with Jake or Randy or both there at Floyd Financial Group. Again, it's not going to cost you a dime. There is no obligation, and certainly there is no judgment. We'd love to talk to you. 417-889-7233. Make that call this weekend and find out more about us online, if you would, by going out to FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, we're going to take another break. When we come back, we're going to be talking about stock splits. What's that all about and more when Show Me the Money continues here at 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about stock splits, something that people have been asking me a lot about lately with NVIDIA.
And Jake, I remember when I was a kid, my mother had General Motors stock. It was part of the compensation that my father got at his employment. And let's say that she had 10 shares of stock. She had more than that, but let's say that it split and now she had 20 shares of stock. I thought, well, she's now got twice as much stock. She must have twice as much money. So let's talk about what a stock split really is and why stock split. So first off, what is a stock split? Why does it happen?
I don't know that I would speculate necessarily on why stocks split originally, but I think the most logical explanation for why it happens today, and probably what it was originally, is back in the day when you bought stock, you used to have to buy a round lot of stock. Mm-hmm. So you had to buy 100 shares of whatever that stock is. So that would mean prior to NVIDIA's split here, if you wanted to buy NVIDIA, you'd have to buy 100 shares of NVIDIA at $1,200 a share. So you'd need $120,000 to get started investing in NVIDIA. So that's obviously too rich for most people to be able to invest in without being too concentrated in one stock. So by splitting the stock, and they did a 10-for-1 split in this case, meaning they have 10 times as many shares, but the stock price then adjusts downward to 1/10 of what it was. Therefore, there's no difference in the overall market cap of the stock, the value of the stock. It just makes each share less money and therefore easier to trade inside of most brokerage firms' accounts, which really helps retail traders out more than it helps out institutional traders. But if a stock is able to be traded more often and by more people, that's generally good for the stock over the long term.
Okay, so if a stock is $100, they split it, it could be $50, and if they split it more, it could be $10. Basically, that's what a stock split is that it just makes it more affordable. It makes the value of a single share just a little bit less. So is it better to buy a stock before or after it's split, or does it make any difference?
So it definitely makes a difference. Usually with stock splits, and again, this is very general, so this is not going to apply to every single stock split, but generally with stock splits, it's a buy the rumor, sell the news kind of a thing. Meaning, if we think it's going to split, or if they announce that it splits, then between the date that they announce it and the date it actually splits is where most of the gain is accumulated, if there's any gain to be accumulated out of the split itself. So meaning, like in this case, they announced on, I think it was around the 18th maybe of May. Don't quote me on that, but let's say it's the 18th of May. And they said on the 10th of June, we're going to be splitting the stock. And so immediately the stock started running up quite a lot in the after hours after they said that. And then it continued running all the way through June 10th and then some actually. But I think it's important to understand that the value of the company and the overall value of your investments does not change inherently although there's a lot of people that insist on chasing every single stock that splits. I would say that it probably meant more to NVIDIA than it did to others, simply because it's a stock everybody wants to be in, and a lot of people could not get in it because of the high price.
Right. Okay. I wanted to talk about the advantages of stock splits and then some of the disadvantages of stock splits. As you said, companies split stock to make them more affordable, but is a result of the stock split, does it result in greater liquidity for the stock?
Yes, generally speaking, when you split a stock, like you said, you have greater liquidity. So you have more people that can buy. Therefore, more buyers equals, if you want to go sell, there's more people that could potentially buy it, and just liquidity goes up overall. For example, Berkshire Hathaway, right? So Berkshire Hathaway is trading at like $625,000 a share. And that's because it's never split since the very beginning when Warren Buffett founded the company in the 50s, right? And so if you go all the way back there, it wasn't always that high, but because he never split it, how many people can go buy a share of Berkshire Hathaway for $625,000? Not many. It's very common for Berkshire Hathaway to trade, maybe 1,000 or 2,000 shares in a day worldwide. Versus like a lot of other stocks, there's lots of stocks that trade millions and millions of shares. If you've been watching the GameStop saga, and I don't want to get it too far into that, but it's trading 100 million shares a day. And so liquidity, to your point, is really the main reason why you would split a stock, is just having the ability to have more people in it, which is more demand, more ease of buying and selling.
So in theory, Jake, a stock split should have no effect on a stock's price, but it often results in renewed investor interest. True or false?
Yeah, it definitely gets it in the headlines. Again, usually if you look at stocks that have split over and over and over, right, those are successful companies. Therefore, people equate stock splits with companies being successful. It's not causative in nature, but if a stock is splitting, generally speaking, it's a stock that's doing well, right? And so people like to jump on the bandwagon of stocks that are doing well. It's no secret that NVIDIA has been doing incredibly well for quite a while at this point. And, it split 3 for 1, then it split 5 for 1, and now it's split 10 for 1. Those are multiplicative in nature as well, meaning if you had one share and then it split 3 for 1, you now have 3 shares. If it splits again 5 for 1, you now have 15 shares. And if it splits 10 for 1, now you have 150 shares. You can really accumulate a lot of shares doing that, as has happened with Walmart and other companies throughout the years. But again, it's important to understand that there's no value change the day of the split. It's something that happens for the stock to continue to operate and be tradable in the manner that particular stock wants to be traded.
Jake, is it routine to see the share price return to levels at which they previously were before the stock split, leading to another stock split?
Yeah, so that does happen quite a bit. It happened with Apple, happened with NVIDIA. It's happened with lots of stocks. Whether or not NVIDIA will go up 10 times again from here, that's a pretty bold call. I don't think that's impossible, but that would also make the company 5 times more valuable than any other company ever has been in history. That would be a big, big move. I do personally think that NVIDIA could double again from here, which would make it the most valuable company on the planet. And over a long enough time period, yeah, maybe it could go up 10 times, but you're talking about getting the value of that company to $30 trillion. That's an enormous amount of money. That's larger than the economy of all but probably the top 4 or 5 economies on the planet, meaning their entire monetary system, the value of their real estate and everything. You're talking about a lot of money. I think I've done this before on the show, but when we're talking about the T word, trillions, right? It's very easy to lose what that means because it's such a big number that people, one with 12 zeros after it, people just start yawning and their eyes glaze over. But let's say that you have $10,000 in $100 bills. So close your eyes and envision this for a moment. So you have $100 bills, and you've seen the movies where they have a little wrapper around them, that says 10,000 on it, right? So It's very small, and you could easily put it in your pocket. It's $10,000. So 10 of those, if you stack them up, would be maybe 10 inches high in front of you. And that's $100,000. It's not like the movies to have $100,000. You don't need 10 briefcases. In $100 bills, it would sit very neatly in front of you, which means $1 million can go in a large backpack, right? If it's all hundreds. So $1 billion is like an 8 foot by 8 foot pallet, 8 feet high of hundreds. but $1 trillion is a skyscraper of hundreds.
Wow. Yeah.
And so when you really start to kind of think about that, talking 30 skyscrapers of $100 bills is the valuation of the company that people are thinking of there. So I would not hold my breath on NVIDIA going to 30 trillion. I would not bet against NVIDIA going to 4 or 5 trillion, however, because I'm attached to my money.
Don't you have in your office stacks of $100 bills there, something like 50 grand? I believe I sent them to you. And you keep it right there on your desk. I like that.
You know, Jeff, when I first, you sent me that. So he has some movie prop.
It was prop money, yeah.
$10,000.
Looks very real.
It looks very real.
Yeah.
And I think it actually looks more real than the real thing would look. It's what you would envision in your mind. It's a little bit ruffled.
Aged. Yeah,
you know?
it's aged.
And but when I first got it, I left it out on my desk the first night, and the person who cleans the office here, she came and she said, "Oh, you left all this money out on the desk," and I didn't know what to do, so I just stuffed it in a drawer to make sure nobody would take it. And so I told her, but then I went into a couple of client meetings and just started throwing $10,000 on the table, and but I mean, it looks real enough that people are like, why are you throwing $10,000 at me? Because it looks like $10,000.
So it was an interesting thing. But yeah, I had a couple $100,000 of that prop money on my desk too. And my wife walked in. She goes, "Where did you get all that money?" I said, don't worry. It's, when you look at Ozark or some of those shows, that's what that is. Are there any disadvantages that you can think of to a stock split for the investor?
Yeah, so if you split prematurely, so let's say your stock is only $25 and you split 10 for 1. Now your stock price is $2.50. If your stock price ever gets below $1, the NYSE can delist you if it stays below $1 for a certain period of time. So generally speaking, not going to be something that happens unless a stock is in the several $100 range. They're likely not going to split because they don't want to have to contend with that over normal market fluctuation of their stock price. It takes a lot to go from $50 to $1, right? If your stock price is currently $500 or something. Again, the stock split is definitely it's a little bit of a prestige thing, where they say, "Hey, we're going to split our stock. Don't you want to buy some now?" You have to be inherently successful in order to consider a stock split because of the ramifications if you don't. Reverse stock splits are also a thing where, let's say your stock gets under $1 or it's trading at $1, you could reverse split your stock 20 for 1, where let's say you used to have 20 shares, now you only have 1 share, but the stock goes up to $20 from $1. And so the biggest reason companies do that is because it's trading too low and they're in danger of getting delisted. Citigroup did that during the banking crisis, and that's something you don't see as often, but it does happen.
Well, Jake, based on our conversation, I'm sure that our listeners may have some questions about stock splits. If that is you want to come in and sit down and talk to Jake there at Floyd Financial Group about stock splits or anything else on your mind about a journey towards a confident retirement, we are offering a no cost, no obligation, and no judgment retirement review with Randy and Jake at Floyd Financial Group. To get yours, call 417-889-7233. I know you're listening to us here on Saturday, but go ahead, make that call today. Leave your name, your telephone number. It's going to take you less than 60 seconds to do that. Ashley will give you a call back on Monday and set you up with an appointment to talk with Randy or Jake right there at Floyd Financial Group and get your questions answered. Again, no cost, no obligation for this. 417-889-7233. And remember, this one call could make all the difference. Jake, we're going to take a quick break. When we come back, we'll be talking about 5 ways to make retirement less scary and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about 5 ways to make retirement a little less scary.
And Jake, I know what it is like. I mean, I've talked to so many people who've said, I'm going to go from the working world into retirement. I'm not going to be getting a regular paycheck. I'm just scared. I don't know if I should really do this or whether I should wait. I just don't know what to do. Retirement is one of those things that most people have never done before. And if you've never done it before, it can be quite scary. But I don't think it needs to be as scary as a lot of people make it out to be. So let's talk about 5 ways to make retirement less scary. What is number 1 on this list? What would you say is the first thing?
So this is something that we've talked about a lot on this show, which is to retire to something and not from something, meaning have something to do once you're retired and have something to fill your time, have a sense of purpose outside of your job that you can go to once you decide to hang it up. Because if you don't, number one, you're probably going to spend more money, right? And
Right.
you may or may not have enough money to do that. Or worst case, you're going to sit on the couch and watch Netflix and kind of waste away, So it's important to have a purpose when you retire and retire to something, not from something.
Case in point, Randy's not retired, but, he takes a few days off here and there, but he's retired too, being a person who's very active and very physical, riding his bicycles and marathons and training and that sort of thing. And he really is very much into that, and it has been something that he really, really enjoys. So he is retired to that. I know one person in particular who was a school teacher for more than 35 years. He retired from that, but still a young man decided to retire to being a financial advisor. So, you don't have to retire to another job, but just have something in mind that you're going to do with your life. You've got 8 hours a day, 5 days a week. You've got more than 40 hours, 50 hours a week that you've got to fill with doing something. So make that plan right now. What am I going to be doing in retirement? People say, well, I'm going to clean out the garage. How long does it take you to do that? I'm going to clean out every cupboard in the house. Well, what happens after that? I'm going to play golf. Even golf, believe it or not, can get boring if you do too much of it. Fishing off the bank. You've got to have something to retire to. So I think that's really, really important. That's number one. What is number two, Jake?
Number two, cash is king. Make sure that you have some cash on hand. A lot of the experts say you need to have 3 to 6 months living expense. I think the average person that I talk to should probably have more than that in the bank where they can access it. 3 to 6 month living expense is a good start, but really have some money in the bank so that when you go to retire and you turn on your income from your investments, you're not panicking that you're going to get your first check the next month. Otherwise, all your bills are going to bounce, right?
Right.
So it's good to have some cash over there for emergencies, also just for liquidity purposes, and being able to feel like you can spend some money if you need to.
So if your expenses are $6,000, $7,000 a month, maybe you've got $40,000 in cash lying around. Now, do you mean cash such as those $100 bills, or you're talking about cash equivalents? I would imagine that liquidity is important here.
Yeah, so honestly, it's kind of harder to spend $100 bills than it is cash in a bank.
Oh, yeah.
There's a lot of places that won't even take cash anymore. And certainly any kind of financial transaction or big purchase, they don't want cash because they can't prove where it came from, and they're worried about you being a terrorist and everything. So yes,
yeah, they get the pen out and start
cash
running.
in the bank.
They get the pen out. I've had them check a $5 and a $10 bill once in a while. That's amazing. But yeah, cash is not the preferred method of currency these days. I'm wondering if it's ever going to be out of style completely, that there are businesses who will not take cash at all. What do you think?
Well, there definitely are some businesses right now. They're just, generally speaking, they're kind of small businesses, but where I get my hair cut, they don't take any cash there. You have to get your card out, and they put a big notice on the door saying, hey, we don't take cash, so don't give us any crap if you fail to read the sign, right?
Well, I want to revert back here. I got off on a little bit of a tangent there, but cash is king, liquidity. So what are some of the other instruments that you can put your cash into that will perform like cash that has some element of liquidity in an emergency?
Yeah, so right now, very short-term bonds, money markets, CDs, they're all paying, in the 5% range, depending on length of time and everything, which is kind of a welcome thing after 13 years of basically near zero interest rates prior to the last 18 months. Yeah, there's no excuse for not having your cash on deposit somewhere where it's earning something at this point, because pretty much everywhere you go, you can get 4 to 5, maybe even 5.5% on those short-term instruments. If you're in a savings account, you're probably not getting paid very much. I would look at a money market mutual fund, short-term CD, or short-term bonds.
5 ways to make retirement less scary. That's our topic here with Jake Floyd. We talked about having something to retire to, and also cash is king. I would imagine that having a plan has to occupy a very significant part of this conversation.
Yeah, having a plan. This is a list that we did not create here on the 5 things, right? This is something we're kind of reviewing. I probably would have put have a financial plan as number 1. If you have a plan for what's going to happen and the way you're going to approach retirement, and it's a well thought out, well laid plan with a certain amount of money that's safe and you can't lose it, and a certain amount of money that's liquid where you can get to it, but otherwise we're kind of focusing on growing the money If you know all that, then when things get hard, you're not going to panic because you had a plan for that.
Yeah, I would think ahead of any of these, I would put plan up front. And I find that planning has been so helpful in most things that I do. But also, I have a plan for when the plans go awry. You do have to be able to, punt once in a while, don't you?
Absolutely. And I'm going to talk my own book here. Like I told people before, right? Consider your source. But here's me saying this. Having a financial advisor can help you take some of the emotion out of investing. Where when you're managing your own money and you've worked for it, you worked for every penny, right? And you saved it, and that savings represents cumulative sacrifice over 30 or 40 years. Mm-hmm. It can get very emotional when the market is throwing you a curveball or whatever's going on in your investments, right? So having an advisor that can help take the emotion out of it and do what is necessary, if even when maybe you're unable to because it's too emotional, is really a valuable thing.
So we have a plan going here. The next one is asset allocation. How does that play into this conversation?
Yeah, so asset allocation is a term that gets thrown around a lot. But when we're talking about asset allocation, we're really talking about how is your personal pie chart of retirement savings? What does it look like, right? How much do we have in cash? How much do we have in stocks? How much in bonds? What type of bonds? How much do we have in annuities or CDs or life insurance or whatever? So that allocation is your asset allocation. So what this means here, having the appropriate asset allocation, is realizing that you're not 20 anymore and you don't have a 40-year time horizon of work to be able to make the money, right? So your risk usually shifts as you get older, and your tolerance for big drawdowns usually goes away, and probably should go away as you start spending your money out of there, because if you have a big downturn while you're spending money, it's very difficult to get back to even, versus when you're 30 and the market throws you a curveball, it just comes back and goes higher. Right. And so making sure that you have the appropriate asset allocation to handle any type of financial weather, meaning if the market's good, if economy's good, you're making money. If things are bad, you're not losing too much money. Right. And that's part of the plan, too. That kind of goes hand in hand with the last one.
And let's talk about the fifth way to make retirement less scary, Jake. And that would be, I think, very important. Maybe this is actually right after having a plan. For me, at least, it's an income plan. Where's the money going to come from?
Right. I think, I have a lot of people when they retire, because they've never retired before, one of their questions is, how do I actually get money out of my account?
Yeah.
They're like, all I've ever done is put money in. So how's this going to work when I retire and I start getting paid? Maybe we're going to take $2,500 a month off of investments or something to supplement, Social Security, that kind of thing. How does that actually happen? And so having a plan for how much money you're going to take, how often you're going to take it, all the way down to how it's actually going to get into your account. Are you going to do check? Hopefully you're going to do direct deposit to make your life easy. Do you want to do it weekly, monthly, once a year, and just use it as a slush fund? All those types of things. There's no right or wrong way to do that. Like I said earlier with considering the source, here's another one. Know thyself.
Right.
If having your entire year's income in the bank is going to be a temptation, don't do that to yourself. There's some people that have absolutely no problem having, $100,000 at their fingertips and it doesn't bother them and they don't overspend. Right. There's some people that if you put it in the bank account, it's going away. So be careful what you put in the bank account. And so you have to know yourself a little bit there. And that would determine the frequency of which you're going to be taking money out. Again, I don't personally like doing bills more than once a month, so I just usually, if it's up to me, I usually pay people, the first of the month, one time a month. That way they can do their thing and forget about it.
This income plan, you can design it any way at Floyd Financial Group that people want it. Is that right, Jake? If you want to check direct deposit every couple weeks like you did with a paycheck, or you want it once a month, is it up to the client to decide how they want to get paid and when they want to get paid?
Yeah, and sometimes I have people that have, different investments, and every once in a while I have somebody that says, hey, I want to get a paycheck every week, because I was used to getting paid once a week. I just want to see that cash flow come in every week. And so we'll set up maybe bi-weekly from their stock account and then bi-weekly on the opposite weeks from a different account so that they're getting money every week. And again, that's totally personal preference. You can do what you want. Again, personally, I don't want to have to revisit my bills that often, so I don't I don't do that. But again, yeah, if that's something you want to do, we can definitely do it. Probably can't do like daily because these companies will start charging you. But I've seen some of these employers get paid daily.
I've seen that too.
You you work 8 hours and then an hour later you get paid for that 8 hours. I think that's a recipe for keeping people in poverty, in my opinion. But
I would say so.
I guess more power to them if they want. But I really think that weekly, bi-weekly, or monthly is usually the way to go.
We're talking about 5 ways to make retirement less scary with Jake Floyd of Floyd Financial Group. Once again, you're hearing the program today. You'd like to sit down with Jake and ask your individual questions. It's impossible to cover everything that's on your mind in an hour radio program. So we are offering this opportunity for you to have your own sort of private radio program, if you will, one-on-one with Jake or Randy at Floyd Financial Group. You can get that plan by calling 417-889-7233. Again, start your conversation by calling 417-889-7233 and request your no-cost, no-obligation, no-judgment retirement review with Jake and Randy at Floyd Financial Group. It is the weekend, but make that call today. Leave your name, telephone number. It'll take you less than a minute to do that. Ashley will call you back during the week and set up that appointment for you. Once again, that telephone number, 417-889-7233. We also invite you to come online and take a look at us right here at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Jake, this has been a great show. I've really enjoyed your company today, but it is Saturday, and I got a little fishing on my mind, so I'm going to get out there in the lake. And for our listeners, we hope you have a great rest of your weekend. Thank you for joining us. For Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor